I've remarked, I think, in recent weeks that what's been fascinating about the last 3 or 4 years, or at least certainly since 2019, that something happens which is completely different than anything that's happened before in the time that I've been in the economics business. And in preparing this presentation, I discovered another such thing. Because I've been looking for a single variable which was really good at explaining why we have this terrific boom in the US economy, in spite of the fact that everybody was forecasting there would be a recession. And I've talked before about where the money is coming from that, for that is to say the US budget deficit. But it's been pretty hard to find a single variable which was driving it. Until pretty much just this morning, and on the US economics database, let us say the Federal Reserve economic database, I discovered a chart of total construction spending manufacturing in the United States. Now, it's really interesting to understand, or it's easy to understand, how you get a boom in construction spending in the US because we have the CHIPS Act. There's enormous write-offs for people investing in manufacturing construction in the US. But it wasn't until I looked at it this morning that I realized that the average level of manufacturing, of factory building, the amount of spent on factory building up until about 2020 was averaging about $73 billion a month, which is a lot. I mean, that's the US is still a big manufacturing economy, and had been at that level for going sideways at that level for years. But what seems to have happened is that from a low level of 73 billion a month in 2020, as a result of all of this spending, and as a result particularly of the CHIPS Act, the most recent number is more than 3 times that, $223 billion a month on building factories in the United States. And that continued to drive the economy up until pretty much right now. And it seems very interesting that that level of spending is rolling over right now at this pretty much this point of time in the US economy, and declines pretty rapidly from now on. Manufacturing, spending on manufacturing increased at a 30% annual rate in the fourth quarter. It increases at a 14% annual rate in the first quarter. That's what we've just got behind us. But right now we are at the absolute peak of this because in the second quarter, the level of manufacturing, of total construction spending in manufacturing in the United States, as shown on the economic of the database of the Federal Reserves, falls by 3.6%. That is to say, it's peaking right now. So what you've got is this very strong construction, driving a very strong economy in the US up to a level more than 3 times its current level, its long-time level, and it's peaking right now. And what it's forecast to do in the third quarter, calendar quarter of this year, is a fall by 22% annualized, and then fall again by 13% annualized in the fourth quarter, and then it continues to fall every quarter for the next 3 years, which is absolutely fascinating. And if you believe that it's that boom in manufacturing construction for construction of new factories in the United States that's been driving the cycle, and I'm beginning to believe that, then we're pretty much at the peak of growth rate in the US economy. And that means from now on, what we're going to do as growth falls, we're going to get into that wonderful thing that people have been looking for years, which is the soft landing. In terms of GDP growth, in the final quarter of last year, it grew to 3.4% annualized. Looks like it's going to grow by about 1.6, or grew 1.6 in the first quarter. Looks like it's going to grow by about 2.1 in the second quarter. and then it drops into around about 1.5% annualised, really for multiple quarters thereafter. And the result of that is, after growing around about 1.9% GDP this year, next year it should fall, the US growth should fall to 1.6% and stay pretty much at that rate for the next couple of years. And as that happens, then unemployment goes up to 4.6% by the end of 2026. Pretty much a similar scenario to the scenario that we saw from the Treasury documents last week for the Australian budget, that you have this very soft growth for the next 2 years, rising unemployment up to 4.5% to 4.6%, and that's what takes inflation down to 2.4%. But really, it's very rarely that you can attribute an economic cycle to one huge economic variable, but total construction spending on new manufacturing in the United States, having tripled in only a few years, is peaking now, will roll off, and that will generate a soft landing for the US economy. One of the things about soft landings, though, is that they generate a pretty flat outlook for earnings in the US market. And as a result of that, you become increasingly dependent for market movements on what the Fed does. My updated fair value of the S&P 500 is 49.15 points, which means it's slightly overvalued at the moment. But where that goes in the future will depend upon the Fed. The next Fed meeting is on the 12th of June. So I think the summary of economic projections of where the Fed thinks it's going to put rates after the 12th of June will become increasingly important for markets as we go through the year.